let's start with a very nice where we use financial intermediaries in Indian fixed income, money market, and derivatives. This video, guys, we are at topic that the financial intermediaries, and then we are to focus on some financial intermediaries in India, their category, that institutions, and their roles we are going to discuss. Then we discuss on the treasury market intermediary functions, how they are intermediary involved in the treasury market, like fixed income market, money market, or the derivative market. Then we discuss on key institutions supporting both intermediaries like the regulatory institutions, on the Clearing Corporation of India, and then NDSOM, and then the tribes institutions, how they are supporting the financial intermediary, and the why these intermediary are matters more, and what the important roles they are playing for the Indian financial system. Then we discuss some risk management perspective. This intermediary. Then the very important and hot topic, guys, which is the asset liability management. We discuss on the gap formulas in detail. And then lastly, we discuss the market practice relevant to deep fit fund. So these all the things we are going to do in this video, guys. So let's start discussion on what are the financial intermediaries. So guys, we know the financial intermediaries are playing important role. So suppose you have the funds. Let's suppose one of the examples, surplus fund. If suppose your salary is 1 lakh in a month, and the overall cost for your monthly is suppose 50,000 for the rent and your family expenses, or the groceries, or other expenses, EMIs and all these. Total sum is the 50,000, and you will have the 50,000 for the savings. How, what you will do that fund? You will deposit that fund in the bank, or in the mutual funds, or you will deposit that funds in the fixed income market, or you buy the insurance, or you will save that fund in the equity. Let's suppose consider the one of the example, you invest that fund in the mutual fund. So there is the comes the role of the mutual fund institution, like the SBI mutual fund or the ICICI mutual fund. So they take your fund, then that transaction will go to the RTA, then NACBSC platform that register that your transactions, or the way where you are actually invested that fund is that invest in that scheme. So all these institutions are comes in the place a role. So these are the financial intermediary, and then finally the actual borrower, the scheme where that invested, that institution will use your fund and generate income from these funds, because they are the fund deficit, or the borrower they need the funds, and then generate the income, and then back the principal and return to these the mutual fund schemes, and then that funds all these intermediary play role, and that funds comes under in your again pocket. So that's the important role. The different financial industry regulatory, SEBI, RBI, or the Clearing Corporation of India. So these all the intermediary involved, or the UPI while you are doing the payments for these transactions, receiving the payments, UPI play the role. So all these financial intermediaries play a basic role in that. So the general definition of financial intermediaries are, the financial intermediaries are institutions that channelize the funds which I told you from surplus units from saver or investor, depreciate the unit borrower issuer, therefore improving the liquidity price discovery and risk transfer and the market efficiency. So the basic flow will look like the financial intermediary, borrower, investor, and economic growth. Funds is invested in the infrastructure sector, or somewhere UPI development, or some hospital created, or somewhere or the companies. So that's generate the income. So that's boost the Indian economy. Okay, that's why the financial the intermediaries are important. So let's discuss on the next topic, where we are going to look at the major financial intermediaries in India, and also we discuss look at the key institutions in that sector, and the their role. So first one is a commercial bank. So we know the SBI, HDFC Bank, ICICI Bank, Kotak Mahindra, Canara Bank, Union Bank, so Bank of Baroda. Uh, so these are the all the commercial banks, and they basically their business is the deposit, lending, treasury operations. So they are sources the fund from the retail investor, or in the form of fixed income or the equity, and that fund they do the lending for the lenders, for the vehicle loan, personal loan, or they do the corporate loan, fixed income, or the uh, infrastructure loan. So these are all the different types of loan in their lending, and they do the treasury. They use the sources of funds, and these all the operation they manage. So these are comes under the commercial bank. Then the primary dealers like the SBI, DFHI, STCPD, PNB Guild. So these are all the primary dealers. They will do the GSEC market making and underwriting. So they will sell the government securities in the market and do the underwriting for these market. These are the primary dealers. Then the mutual fund. Mutual fund is a very vast industry. So where the key institutions are the SBI mutual fund, ICICI mutual fund, SDFC mutual funds, or the Canara mutual funds. So the Kotak Mahindra mutual funds is there. So these are all the mutual fund institutions, and they will source the funds from the investor. There is a risk is high, but return is high as compared to the fixed bank deposits. So when it comes under the debt or the money market instrument play the important role. So different types of scheme is there. So the debt scheme, equity oriented, short term mutual fund, long term mutual funds. So the sovereign debt. So these are the mutual funds companies. They are created some schemes on the basis they will invest their funds. Then the comes under the insurance companies like ICICI, LIC. So these all are the insurance companies. They source the long term fixed income investors, and they in the form of these that they play the roles. Insurance company are once the uncertain event is happen, then they will play the claims. Otherwise, they will invest that funds in the long term fixed income investor. They play a key important. Then the NBFCs, non-banking financial companies, so like a Bajaj Finance, Serum Finance, these are the NBFCs, and they to play important role in credit intermediaries. Then the pension funds, NPS, EPOO, all these are the pension funds. They are long driver for investment, because they invest. We all the employees are invest funds in the EPFO. So and the NPS, and that funds are comes under the pension funds when the retirement. Then that funds is paid to the investors at the time of retirement. So if someone join at the age of 18, 20, or the 25 in some organization, and the EPFO amount is monthly reduced from his salary, and it will be saving for 20 to 30 years for the EPFO fund, and at the time of retirement he get the benefits from these amounts. So that's the longer duration. The EPFO is a key intermediary for the investment for the financial institutions, which will source the funds from the long term duration. You know how much the volume of and how much the funds are collected in the form of the pension fund. Then the financial market infrastructure. So where the key role is played, the Clearing Corporation of India, National Stock Exchange, Bombay Stock Exchange, they play the market role as a clearing or the settlement or the risk management. So these are all the financial intermediaries in India, and they play the important role. So let's move on the next slide, where we are going to discuss on treasury market intermediary functions, intermediation functions, guys. So fixed income market, money market, and the derivative markets are the treasury intermediaries, and their functions in the fixed income is a GSEC trading investment, corporate bond investment, statutory liquidity ratio, portfolio management, yield curve development. So all these part comes under the fixed income market. Then we are going to the money market. So money market instruments are less than 1 year. It is a short term duration, and the capital market are involved in the long term duration. So call and notice money, tri-party repo, commercial papers, or the certificates of deposits. All these instruments comes under the money market, and the derivative and its functions are the interest rate swaps, currency derivative, credit risk transfer instrument like hedging. We use the currency swaps, and the risk hedging solutions we use in the derivative market. So betas and all this comes under the derivative. So let's discuss on the key institutions supporting these intermediaries. So what are the key institutions they are supporting these intermediaries? So first one is RBI, second one is CCIL, Clearing Corporation of India, NDS on, and the tri-parties, the institutions they play the important role. So the government is play has the regulator for money, government security, and the derivative market. So government are the RBI is a regulator, play the role this, and then the conduct the monetary policies, liquidity management through repo and the reverse repo. So they will do the repo and reverse repo to manage the liquidity in the market. Then the Clearing Corporation of India Limited, it is the central counterparty. It's play the important role, and then the guarantee the settlements. There is a there is always the counterparty. So that's why the Clearing Corporation of India is comes into the role, and they will guarantee the settlement, and it will reduce the counterparty risk mitigation. So there is a, if suppose the contract between the two parties and there is a chance the alternate counterparty will default, so that will reducing, we will create the Clearing Corporation of India counterparty risk mitigation, and the margin and collateral management. So they will just take some margins in this clearing corporation, and then the collateral management, the transaction will happen smoothly. So that's the Clearing Corporation of India Limited role. And then the NDS on, so RBI Electronic Order Management Platform. So it's the important platform where all the orders will manage the electronic platform, and smooth and track and data will create it. Then the G6 secondary market trading platform, it will once the primary market, the issuance of the government securities will happen, then it will trade it on the secondary market, where the buyer will buy and seller will sell the government securities. So that's will done in the secondary market. And the transparency price discovery, if it will be transparent and the price discovery will happen. Then tri-parties collateralized overnight borrowing and lending platforms is important role play, major through the CCIL, and operate through the CCIL, major liquidity management institution. So it's, and the liquidity risk management institutions for the tri-party institution. So let's move on the next slide. Why the financial intermediary matters for the Indian banking system? So it's improve the liquidity, obviously. So the smooth flow of funds will happen. We are easily the source of fund or the destination of funds, and what the institution play the important role in the source of funds, and who is utilize that fund. So it will improve the liquidity management in the systems in the Indian banking financial system or the Indian financial system. Then reduce the information asymmetry. Yeah, it will the information is available. We easily identify the sources and destination of fund, facilitate the risk transfer. So use different hedging speculations techniques to arbitrage policies to facilitate the risk transfer, then enhance the market efficiency. So if the market is able to easily source fund, the destination fund, track the all the market risks, and so that's the enhance the market risk efficiency. We are going to look this in the next slide. And then the improve the monetary transparency with the RBI and monetary policies, supporting the government borrowing program. So like government will enhance supporting to create the different institutions, the power transportation, National Bank for Financial Infrastructure, or the NHI, they issue the bonds and to collect the funds. So these all the schemes, they play important role for supporting government borrowing program and strengthening financial stability. Obviously, if we someone need funds and we have the funds for them with appropriate rate of interest, with proper sources of fund, proper asset liability management, we going to discuss in this. So that will help us to financial strengthening in Indian system. So let's discuss on a very important role which is played by the financial intermediary, which is a risk management perspective. So where we are going to discuss on the type of risks and how intermediary manage these type of risks. So first one is the interest rate risk, which is the most important and which is directly impacted on the balance sheet of the institution. So where we will do the duration, modified duration, and basis point PV01 or the BVPP, we will use this the interest risk management, how the upside or the downside of interest rate will be act on the portfolio, and then the liquidity risk management, where we do the asset liability management or the liquidity buffers watch we have, where we calculate the net stable funding ratio or the liquidity coverage ratio, which is for the 30 days, or the net stable funding ratio, which we calculated for the available stable funding ratio divided by the required variable funding ratio for the 1 year. So that's all the technique we use for to manage the liquidity risks. Then the credit risks, we will do the rating exposure. We will calculate it in the credit risk management, the probability of default, loss given of default, exposure of default, unexpected loss, expected loss. So all these things we calculated, or the credit loss mechanism, which is recently RBI development, will going for the rating and exposures, how much the we will also calculate it the how much the exposure have the single industry or the exposure risk management or the group exposure. So these are all the techniques we utilize in the credit risk management. Then the market risk, so value add risk calculation. The value add risk is nothing but the how much the risks we in that portfolio will have the certain confidence level with certain amount with the time duration. So that's we calculated in the value at risks, and we use the stress testing, scenario analysis. So these are all the technique we use in the market risks manage market risks, and also the counterparty value at risks, the CUR expected shortfall, and the counterparty risks, the clearing corporation settle guarantee, the counterparty risks. So these are the important notes, and this is a note, guys, you should keep in mind. The clearing corporation of India Limited significantly reduced the systematic risk which is in the market by acting as a central counterparty. Systematic risks, unsystematic risks, you should understand. Therefore, by improving the confidence and efficiency in Indian fixed income and money markets. So these are the risk management perspectives. So let's discuss on next slide, where we are going to discuss on asset liability management role, how these counterparties or the intermediaries are at play. So the financial intermediary continuous manage the gap for the risk sensitive assets to the rate sensitive liabilities. So risk sensitive assets to the rate sensitive liabilities. So the positive gap benefit when the rates is raised. So positive gap is positive for the rate is weak, and the rise, and the negative gap is benefit when the negative is fall. So risk sensitive assets, we have the buckets where we collect all the risk sensitive assets, and we have the second bucket, we have all the like rate sensitive liability. So that will help us to the interest rate risk management, or that the it's manage how much the we are going to funds, or the liquidity risk management, that will help us. So treasury desk is actively manage the duration, liquidity, interest rate sensitive to investment and hedging, these all the transactions. So let's discuss on the market practice relevant for the FIMMDA, how these market practices are relevant for the FIMMDA institutions. So the standard valuation methodology for the debt security, yeah, it's the important role he will play for the standard valuation. Different techniques he use different AML techniques to valuations for the debt securities, to to do the valuation of debt security. What of FIMMDA do? The market convention for the fixed income instrument, benchmark yield curve, dismiss dimensions, best practice for treasury and the derivative markets, and coordination with RBI, bank, primary dealers, and also to the primary dealers, and also mutual funds and market participants. So they collaborates and coordination with all these institutions will done by the FIMMDA and and it is managed for the institution. So FIDMA role ensure the uniform valuation, transparency, market standardization across the fixed income market. So they are play the important role in the fixed income market. So it will ensure that the uniform valuation, transparency, and market standardization across the fixed income market. So these are end of this video, guys. So once again, thank you so much, guys, for attending this interesting seminar. If you are interested in the financial market, or if you are understand the how the financial sector will look like in the future, so please do like and subscribe my channel. So I am creating videos on this topic. Once again, thank you so much, guys.